March 2001, South Africa moved from a source-based to a residence-based tax system for individuals. This meant that tax residents will be subject to tax on worldwide income, excluding certain exemptions or exclusions. The change also meant that non-residents will be subject to tax on income from a source within South Africa. A tax resident may also, due to a matter of choice or circumstances, cease to be a tax resident of South Africa. Such change in tax residency status must be declared to SARS, as there may be consequential tax implications. An individual is a resident for tax purposes in South Africa either by way of ordinarily residence or by way of physical residence. The concept of ordinarily residence is not clearly defined, and the determination of whether or not an individual is an ordinarily resident for tax purposes must be done on a case-by-case basis. Quite a number of factors must be taken into account to make such a determination. An individual can also become a tax resident by way of physical presence. An individual who is deemed to be exclusively a resident of another country for purposes of a double tax agreement is excluded from the definition of resident. Well, to discuss this issue further, we have invited Legal Manager for Cross-Border Taxation, Thomas Loban, who joins us now from Johannesburg. Thomas, a very good evening to you. Thanks for joining us and a warm welcome to The Globe.
Thank you very much for having me. Good to be here.
All right, now do explain for us how these changes in the tax regime have impacted South Africans, South African expats.
Well, since 2001, as you rightly mentioned, South Africa had or has been part of a residency-based system of tax, where a tax resident in South Africa is subject to tax on their worldwide income, i.e. it doesn't matter where the source of that income is, whether that's South Africa or not. On the other end of the coin, a non-resident would be subject to tax only on amounts from a source within South Africa. Now, quite notably, what had happened from the 1st of March 2020 was the exemption that was previously available to South African residents working abroad for more than 183 days in a 12-month period, of which more than 60 days were continuous. Their employment income was exempt in full. From the 1st of March 2020, that was limited to 1.25 million rand. Now, what we've seen recently is a communication from SARS this week that essentially serves a dual purpose to reaffirm the fact that if an individual ceases their tax residency in South Africa, there must be a formal declaration made to SARS to support this. And they've introduced a new formal declaration format that can be used for this purpose as well.
Now, Thomas, you just mentioned the tax exemption, especially for the expatriates, who are living in different parts of the world. So does that mean that those expats are taxed differently from residents in South Africa?
So if you are working abroad for sufficient periods of time, as an employee specifically, you do have that first 1.2 million rand essentially tax-free as an exemption, which must still be claimed in your returns. And that's different to a person who's living and working in South Africa exclusively, who doesn't have that exemption available to them. And it's a form of relief that's been provided to expatriates. Although, like I'd said previously, that was an exemption in full on their employment income. So the topic of the 1.25 million rand cap being introduced on an annual basis was quite a contentious issue for a long period of time leading up to its introduction and for some time afterwards as well.
Let's extend our analysis and discussion to the recent changes to the tax and how they affected expats, especially after recent reports that they're taking all their money out of the country and are cutting ties with South Africa.
Well, essentially what you would be talking about there is a form of financial immigration, which also underwent a change on the 1st of March this year. Previously, where an individual financially immigrated from South Africa, it would involve becoming non-resident for exchange control purposes as well. And that's something that's been phased out. Now, where a person no longer sees South Africa as their real and permanent home, a place to which they're going to return on a permanent basis in future, they do cut their ties with this formal declaration in terms of South Africa's domestic tax laws. And they no longer have to file returns in South Africa if all they're earning is foreign sourced income. And now what we're seeing is a lot of South Africans taking their funds out of South Africa, essentially their retirement fund interests, where they've been a non-resident for 3 years or more, because they don't want to have that tie. They don't want to be approached by SARS in future asking for tax that they don't feel they owe or they don't owe.
All right, you did touch on the 1.25 million rand cap on the expat tax exemption, but let's talk about the expatriate tax petition group's role. What is it and what it seeks to achieve?
Well, the Expat Tax Petition Group was founded by Barry Pretorius after National Treasury's announcement about their proposed repeal of the exemption, allowing foreign taxpayers to exempt their foreign employment income in full. They, in tandem with a lot of other individuals, but most notably Tax Consulting South Africa, had approached Parliament to make representations to this effect. And that is actually the reason why we have a 1.25 million rand cap rather than a complete repeal of that exemption, which could have proved incredibly disastrous to expatriates abroad, especially where they're living in perhaps a so-called zero tax jurisdiction, but actually has other underlying taxes and expenses that the expatriates have to incur through a high cost of living, a sales tax or otherwise.
And those already living abroad, how do they cease to be tax residents of South Africa?
Well, essentially, there are now two formats in which you can disclose this to SARS. Alternatively, there are three bases on which you can become a non-resident. So the first and the second are by declaring to SARS that you are no longer ordinarily resident. You no longer see South Africa as your real and permanent home. You're not going to be permanently returning in future. Alternatively, you never were ordinarily resident, but you'd spent sufficient periods of time in South Africa to become a resident simply by virtue of your physical presence here, which that test doesn't apply in the first place if you are ordinarily resident. Alternatively, if you're still seen as a South African tax resident in terms of our domestic laws, for example, you intend to come back in future, you might be able to use the rules in terms of a double tax agreement, the so-called tiebreaker test, where you're seen as a resident in the other country in which you are living for tax purposes, and the tiebreaker test is found in favor of the other country because of your factual circumstances. Now, what you have to do is one of two things. This is either declared through your returns, which SARS will follow up on audit, and they will ask you certain questions, such as the type of visa that you have in the other country, whether you've already taken up permanent residence there, any property you still have in South Africa, other ties, or you might be able to submit a formal declaration form to SARS with a motivational letter and a copy of your passport and travel diary. Now, that motivational letter is a very important thing because that is what sets out, legally speaking, why you are eligible to become a non-resident. So it's not simply just a case of you leave South Africa or you left a number of years ago. You may well and probably will still be regarded as a South African tax resident until you make this declaration in your returns or in terms of the formal declaration letter that you submit to SARS. It boils down to the new form of financial immigration, for example, or it boils down to a declaration in terms of a double tax agreement.
I'm actually glad you touched on the issue of properties remaining in South Africa. If I cease, to be a tax resident and I cut ties with South Africa, but I still have properties back home in South Africa, both movable and immovable properties, does that mean I'm still liable for tax?
Well, not necessarily. remember, ties in South Africa are not exclusively reserved for South African tax residents. You may well still have a property in South Africa, but that is where your intention becomes a very important thing. And because in South Africa, the burden of proof is on the taxpayer, the evidence that can back up that intention is also important. So retaining a property is definitely one of a multitude of factors that are considered. But so too would be, are you renting out the property or are you leaving it as a holiday home? These are things that must be weighed up overall.
Yeah, I guess that will be the guide to SARS, perhaps whether to, for their determination on whether they should tax me or not, whether I'm renting the property out or it's just, a property that generates no income at all. Would that be a consideration?
Well, remember, lifestyles and reasons for that individuals may have for their circumstances are very broad. So this is something that is very nuanced and should not be lightly considered, because otherwise you might have a SARS auditor telling you something completely different or an angle to it that you may not have considered. If you're not able to satisfy that burden of proof on a balance of probabilities, essentially to convince SARS that you do not see South Africa as your real and genuine home, or if you do, another country has a stronger claim to tax residency under a DTA, you're not going to be able to cease your tax residency and you will remain subject to tax on your foreign income.
And when must a declaration be made? Before I leave South Africa or the minute I start paying tax in a foreign country?
Well, paying tax in a foreign country is not necessarily the deciding factor. Definitely having left South Africa, whether it be temporarily, if you're going to be relying on a double tax agreement, or permanently, certainly you must either be temporarily in South Africa for whatever reason, or have already left. Your home should not be South Africa if you are making this claim, or at least not the place you are currently living.
Okay, if you previously declared that you ceased to be a tax resident, how do you request for confirmation?
Well, that's actually something that SARS made very clear in their announcement, and they set up a webpage for it just this week as well. You can send a letter to SARS, which needs to contain the background to which you're making this request, the basis on which you believe you previously in the past ceased to be a tax resident in South Africa, and the date and manner in which SARS had previously been informed. Now, in this also lies an implicit fact, which is that that declaration must previously have been made. It's always been available through a double tax agreement or a financial immigration mechanism or through your returns. It's always been there. And you will always have been seen as a tax resident unless you made it known to SARS that you no longer are. You can't simply walk out and not see it as your home and expect everyone to be on the same page. So that letter that you send to SARS must include that as well. You need to show SARS that you did take that action to cease being a resident on formal record.
And under what circumstances is a declaration declined?
Well, a declaration will be declined if factually you are not eligible, or alternatively, again, because the burden of proof is on the taxpayer, you cannot prove through evidence that that is the case. It's quite simple.
All right, Thomas, great chatting to you, man. Thank you so much for opening our eyes to all these matters.
Thank you very much.
All right, that was Legal Manager for Cross-Border Taxation, Thomas Lobben, who joins us from Johannesburg.